Right now, somewhere in America, there is a savings account. It belongs to a perfectly normal person. Maybe it is yours. It has $10,000 in it, sitting patiently, doing the responsible thing that responsible people do. And it is earning, at the national average, approximately $42 per year. $42 on $10,000 in 1 year. That is a 0.42% annual return, which is the average interest rate on a savings account at a large commercial bank in the United States, as of the last time anyone bothered to check. Now here's what the bank is doing with that $10,000 while it sits there earning you $42. It is lending it out at 7.5% on a home equity loan, at 10% on a car loan, at 20% on a credit card balance, at 28% if you missed a payment and they bumped your rate. The bank took your $10,000, lent it to someone else, collected between $750 and $2,800 in interest on it this year, handed you $42, and called it a savings account. That gap between the $42 you earned and the $2,800 they collected has a name. It is called the net interest margin, and it is the engine that makes commercial banking one of the most consistently profitable industries in the history of organized finance. In 2023, the 4 largest U.S. commercial banks, JP Chase, Bank of America, Wells Fargo, and Citigroup, reported a combined net income of over $100 billion. That is not revenue. That is profit. After expenses, after salaries, after everything, $100 billion in a single year from an industry whose core product is borrowing money from you cheaply and lending it to someone else expensively. And the part that should keep you up at night is that this isn't a secret. It is not fraud. It is not illegal. It is the disclosed, advertised, fully legal business model of every commercial bank operating in the United States. They told you the rate. You agreed to it. You signed the paperwork. The question is whether you understood what you were actually agreeing to. Here is the history you need. Because this system did not always work this way. Before the 1980s, savings account interest rates were regulated under a depression-era rule called Regulation Q regulation. Q capped the interest rate that banks could pay on deposits. The logic was to prevent banks from competing too aggressively for deposits, which regulators worried could drive them to take excessive risks in lending to cover the higher deposit costs. Rates were capped at around 5.5%. And then in 1980, Congress passed the Depository Institutions, Deregulation, and Monetary Control Act, which over 6 years phased out Regulation Q entirely. Banks were now free to pay whatever they wanted on deposits. Theoretically, this should have been great for savers. Banks could now compete on deposit rates. The best rates would win the most customers. And for a while through the 1980s and into the 1990s, that competition was real. Savings account rates tracked the federal funds rate fairly closely. When the Fed raised rates, banks raised deposit rates. You got paid something that at least partially reflected the actual cost of money in the economy. And then something changed. It changed slowly, then quickly, and then permanently. Because by the mid-2000s, the major commercial banks had grown large enough that deposit competition became less urgent. If you bank at JP Chase, and JP Chase has 4,800 branches, and an app that your direct deposit is already wired into, and all your bill payments run through, the inconvenience of moving your savings account to a competitor is significant enough that most people simply do not do it. The banking industry discovered what every subscription business discovers eventually. Inertia is more valuable than a good product. And then 2008 happened. And then 2009 happened. And the Federal Reserve cut interest rates to effectively zero. And banks, who were no longer competing aggressively for deposits anyway, passed essentially zero of the rate environment on to savers. The federal funds rate stayed near zero from 2009 to 2015. It went back to near zero from 2020 to 2022. For over a decade of that 14-year stretch, the average savings account rate at a large commercial bank was between 0.01% and 0.06%, 0.01% on $10,000, that is $1 per year. $1, and during that same period, banks were not lending at zero. Credit cards were charging 15 to 24%. Auto loans were running 4 to 6%. Mortgages were historically cheap, but still at 3 to 4%. The spread between what banks paid depositors and what they charged borrowers had never been wider, and depositors, by and large, stayed put. Because of friction, because of habit. Because it is astonishing how much money people will leave on the table rather than spend 40 minutes switching bank accounts. The behavioral economists call this status quo bias. The banks call it a stable deposit base. They mean the same thing. They are just more grateful about it than the economists are. Here is the mechanism that makes this work at scale. Banks do not need to raise deposit rates to attract money. They already have the money. The average American has had the same primary checking bank for over 17 years. 17 years. That is longer than most marriages last. That is longer than most car loans, mortgages, and stock market cycles. People change jobs, change cities, change careers, change relationships. They do not change banks. And because banks know this, they have no competitive pressure to improve the savings rate for existing customers. The savings account rate you see advertised is designed to attract new customers at the margin. The rate your existing balance earns is often not that rate. It is whatever the bank decided to pay people who were not paying enough attention to leave. In 2023, when the Federal Reserve raised rates to between 5% and 5.25%, something interesting happened. High-yield savings accounts at online banks and credit unions began offering 4.5% to 5.25% on deposits. These are FDIC-insured accounts. The same legal protection. The same deposit insurance. Just better rates. At the same moment, the major commercial banks were offering between 0.01% and 0.5% on their standard savings accounts. The spread between a high-yield savings account and a standard big bank savings account was over 4.5 percentage points. On a $50,000 balance, that difference is $2,250 per year. $2,250. That is not rounding error. That is a car payment, a month of rent in a lot of cities, or approximately 42 years worth of interest at what the big bank was paying you. And the large commercial banks knew this. They were not oblivious to the rate environment. They simply calculated, correctly, that the majority of their existing depositors would not move their money regardless. And they were right. Deposit outflows from large commercial banks in 2023 were real but modest relative to the total deposit base. Most people stayed. Most people kept earning 0.5%, while online banks were paying 5%. The inertia held. It almost always does. Here is the part I want you to sit with, because this is where the system becomes genuinely difficult to defend. The deposits that large commercial banks hold are not a gift from their customers. They are a loan. You are the lender. The bank is the borrower. When you deposit $10,000 in a savings account, you are extending an unsecured loan to a financial institution at a rate the financial institution sets unilaterally, can change at any time, and is not required to advertise prominently. And in exchange for that loan, you get the convenience of ATM access, a debit card, a mobile app, and the reasonable assurance that your money will be there when you want it back. That convenience is worth something. It is not worth zero, but it is probably not worth 4.5 percentage points per year. And the fact that you are also the person whose credit card balance is being charged 20% by the same institution that is paying you 0.5% on the deposits it is using to fund those same credit card loans is a level of irony that the banking industry has simply decided to be comfortable with. Here is the uncomfortable truth. The savings account is the single most widely distributed financial product in America. Over 130 million Americans hold one. Most of those accounts are at large commercial banks. Most of those accounts are earning between 0.01% and 0.5%. And the reason is not that better options don't exist. They do. They are FDIC insured. They are accessible online. The reason is that the big banks have calculated, with extraordinary precision, that the cost of improving their deposit rates for existing customers exceeds the cost of losing those customers. Because they are not losing those customers. The most effective product moat in American finance is not technology. Not a better app, not a superior investment product. It is the sheer human tendency to not deal with something that isn't causing immediate, visible pain. A 0.5% savings rate does not cause immediate, visible pain. It causes a slow, invisible compounding drain that costs you thousands of dollars over a decade that you never think to measure because you never see the bill. The money the bank kept is not a line item anywhere. It is just the absence of money you never saw yourself having. And absences, it turns out, are very easy to ignore. So here is the question I'll leave you with. If you knew that a different account at a different institution was paying you 10 times what your current account pays, with the same legal protections, the same insurance, the same money waiting for you when you need it, would you move? And if the answer is yes, but you haven't, you are not unusual. You are the model the entire business was built around, Drop your take in the comments, because I want to know, is this the bank's fault for designing a product around your inertia? Or is this on the depositor for not doing 40 minutes of homework on where their money sleeps? Because the answer to that question says a lot about who you think is responsible for the $2,250 that silently didn't show up in your account this year.